Hello and welcome back to the complete day trading course by Wealthy Education. In this video, the second module begins, and the first video is how to use support and resistance. Well, if you do not know what support and resistance is, it is an area, that supports or resists climbing. So, for example, you have a chart like this and your prices go higher, and then they run into trouble at a specific point, and then they run into trouble again, and they continue to run into trouble. That would be resistance, and that's where a lot of sellers are coming in, and it is resisting going higher is the way to think of it. Now, that same level could also be support down the road. Maybe we continue to sell off, and we find that area to be supportive. There's a lot of buyers there. There is a phenomenon called market memory that levels will offer resistance, and then once you finally break above it, a lot of times we'll offer support. Now, there's a lot of reasons for that. The first one is that anybody who was short or selling at this point is more than happy to get out with a small loss after they've been blown out a little bit, so they have to turn around and buy. Another reason is that people may have missed the move and they see an opportunity to get involved at a clear breakout, and they go ahead and start buying here as well. Then the third reason from an institutional side is that you may have an order to buy 50 million shares if you're a hedge fund or if you're a desk or something like that. So you have a huge basket order, 50 million shares, 10 million shares, whatever it is. Well, what happens if you only get 3 million filled here? And you have a target of, in this case, say 210. The customer wants to buy 210 or as close as possible. And you get another 2, and then it bounces. And then you get another 4, and then it bounces. And then finally you get your last million shares there. And that's what you're seeing a lot of times. So again, it's where price gets resisted. That's resistance. Supported, where buyers come in. And then market memory dictates that what's once the ceiling will now become the floor. You can also think of it as a high rise. So we're bouncing around in here, and then we jump to the second story, and well, now that's the floor, and the third story, and et cetera, et cetera. And it does work both ways. If you fall, then that becomes a ceiling. The floor becomes a ceiling. Okay, so what's the importance of support and resistance? Well, the importance of support and resistance is it's where buyers and sellers come together. And think of it as your roadmap for where the market may go. There is no such thing as trading and ignoring support and resistance unless you are basically gambling. Support and resistance is the very basis of almost all technical trading. You can draw support and resistance very easily in TradingView. You click on the trend line, go to horizontal line in the sub menu, and you can plot that line and you can drag it back and forth. And in this case, you can see that there are buyers right around here. You can see several times the market tried to break down below there, but the buyers continue to return. So that's a sign of support. You could also look at this as resistance. You can see we just couldn't break above that area. I would also submit to you that sometimes it's a zone. So you can see that clearly there was an entire zone where the sellers were keeping the market down, and then we broke out, and you can see we retested. What was once the ceiling became the floor. So market memory, as I had mentioned previously. So how do you determine a breakout? Well, there's a lot of different ways. And for this, let's go ahead and use a very simple example right away. So I'm going to go ahead and change this to 195. Because one thing that you will find out about support and resistance is that it tends to form around round numbers like 195, 200, especially around like 200, 250. Those are very important numbers, but it tends to be at a round even level like that. So let's go ahead and jump down to the hourly chart. And I'll go ahead and zoom back, and you can see, well, one way to determine an upward breakout, this is the easiest way, is you just gap above that resistance to kick off the day. Well, that's obviously a very strong breakout. A breakout will also quite often have that market memory that I mentioned. So, for example, you can see that, I'll go ahead and zoom out here, and you can see that this resistance here got broken down through, but even down the road, you can see the market memory. So once you break above this obvious resistance area, because you can see what price continues to flip back and forth, we jumped above it and then found support. So a lot of times what traders will do is they will look for a scenario where, I'll go ahead and draw this with my drawing tools, but they'll look for a scenario where, there's been a lot of resistance here, and then we finally break out. And what they look to do is buy the pullback that shows signs of support because of all those reasons that I mentioned previously. The same thing in a downtrend. So we finally break support, and they'll start shorting right around there. And the reason is because a lot of people that are on the wrong side of the trade are going to have to reverse in your direction. So, for example, let's go ahead and zoom out a little bit, and I'll show you how this can play out. We had a break in this area here, and you can see that the price pulled back just a little bit and then took off. And you'll see that over the longer run, price will return to areas. See that resistance there? It broke through it, but interestingly enough, as you can see, price couldn't get back up there. We broke through that support level. We tried to get there, and then we saw negativity again, so that would be the pullback in short area. And I suspect that somewhere, yeah, there you go right there, that previous support and resistance has offered support. So for those who missed that move, they would be paying attention down the road. They would recognize that there was a lot of support there. They would look to the left and they would say, well, this is an area that's been important. So that's waiting for that pullback, albeit in a much longer time frame. I mean, clearly you're waiting much longer for that particular move, but it does come into play. So you can see that there is a lot of back and forth between main areas. And there is something to be said for round numbers. So, for example, you can do things like, and you can experiment with this, but let's just go ahead and plot a couple round numbers that I see just, really quickly looking at this. And I'll go ahead and do 150. So those are all round numbers. And these round numbers attract a lot of attention. So I'll even zoom out to the weekly here and see if I can see. Yeah, so you can see that 130 has caused a lot of resistance. 140 has caused some support because we have bounced from there. 50 was resistance, and then it turned into support a couple of different times. So you can see how this goes back and forth. Now, there are a couple of other things that I would add, some caveats. What you really want to see is a breakout with some type of volume. So I'll go ahead and put that 150 back up. And let's go ahead and zoom in on an hourly chart. And I'll have to scroll back here. But what we're looking for is some pickup in volume on one of these moves. So this was pretty strong volume as we got here. This was a nice reversal candle setup, and you can see that volume is picking up to the upside. And then we really peaked here when we gapped. So that's a good sign that the uptrend is going to continue. And remember, and I can't stress this enough, you need to be looking at the uptrend from the longer term standpoint, not the last couple of hours. That doesn't matter. Big, massive green volume spike here on this green candle. That was the first sign that this was probably going to hold, and you can see that it in fact did. Volume is very crucial because it shows interest in the market. Now, what time frame to use is something that is of personal preference, but again, I would point out that the higher the time frame, the more reliable, and then you can just simply drill down to shorter time frames that you're more comfortable with. So, for example, if you have an area on JP Morgan that you're paying attention to, and you look at it and you say, okay, I want to get the best entry possible. Well, then in that scenario, you can look towards shorter time frames. And that really comes down to what kind of time you have. So, for example, I'll go ahead and draw this 110. I'll zoom in on the hour. Let's see what we can see. There was a shooting star right here with a gap just above that area. Once you broke the hanging man, that's also another reason to sell. There's plenty of volume to the downside still. So 1 hour chart would have been very reasonable. To me, when I look at this, it seems that there's about a $1 area as you zoom in on these lower time frames that just seems to be a zone of resistance. So the shorting made sense. And at this point, you're a couple bucks to the good. You could also go to, say, 15 minutes and then start to look for signs there. So here's a hanging man and a very negative candlestick. The volume isn't going to be as high on a 15-minute chart, obviously, but it is a technically viable setup. And the beauty of using this is that your stop loss could have been at 111. Your entry could have been at, say, 110 and a quarter. So you would have been risking 75 cents as opposed to like maybe a daily candle, that could be $2. And that's kind of the point. So as you drill down for ever increasing granularity, you can tighten your stops, but it all needs to be in the context of the higher time frame. So 110 matters on the short side on the long-term chart. So I showed you, and that is a bearish candle there. There's another bearish candle there. There's another one there. So really, at this point, you could have shorted there, breaking this 3-candle reversal, or 4-candle reversal for that matter. At 1040, stop loss at 110.80. That's 40-cent stop loss. So even there, you can cut down your stop loss from 75 cents to 40 cents. So really, there is no right or wrong time frame. Just make sure you know what's going on in the big picture, and then you can get granularity. I mean, you want to give yourself some room to move, obviously, but this could have been taken with as little as 40 cents stop loss. Most of the time, when you start talking about strategies for breakouts, what you're looking at is the overall attitude of the market and perhaps ranges that may or may not matter. So as a general rule, what I like to see is once I've reached 1-to-1, so, let's say in that 40 cents in that example. So I'm risking 40 cents on the 5-minute chart. Well, once I'm up 40 cents, at that point, I'm at break even. There's no point in losing because you are at 1-to-1 there. And then I just simply drag my stop loss along with me, maybe moving up every 10 cents or so. That's one strategy. If I know that there is a target that has attracted a lot of attention, let's go ahead and change. Let's go ahead and change our stock chart. Let's see. Let's go to Citigroup. And let's go to daily, and this will be easier to see from a daily chart, but it will tell you the same story. So for example, if I take this reversal candle here, and I know that there's a lot of resistance up here, then I take my profit there, or at the very least, regardless of what happens, I'm at break even. There's no need in taking that loss. Let's go ahead and look at a couple other examples before we move on so that you get this down. This is AT&T, and this is a daily chart. But you can see I have major levels drawn out. You can do the same thing on short-term charts. So if you were to take a short, you could ride it all the way down to 35. Let's go ahead and move to the 15-minute chart. You can see that we have a nice grind here. One simple way to take a trade in this, or to manage your trade in this, is to recognize that the last swing low, so we had a swing low. If you were long here, for whatever reason you decided to go long, you pulled back and then you bounced again, well, your stop loss can move up to the latest swing low. Eventually the market will tell you when it's time to get out. So those are three strategies. You do the 1-to-1, you do the next major area, I'll just put that as MA, or you trail your stops and swing lows or swing highs. Those are all three very valid ways to manage your trade so that you can take advantage of support and resistance and dynamic support and resistance, how it continues to form in the market. The trailing stop, I'll draw some lines, down here, hammer, perfect hammer, nice volume, could have taken that. We rally, we come back here. Once we take off from here, make a fresh new high, your stop loss goes there. High here, high, low there, high there, we tick above there. Could have your stop loss there, might have gotten taken out there, but that's a nice little move. And there are variations on that. It comes down to your psychological comfort. But clearly as a day trader, you can make nice little bits and pieces out of the market following this trailing highs and trailing lows stop loss placement, which I do like in a trending market. It just depends on how the market's moving. If there's a lot of volume, if it's a steady trend, sometimes it's not. So that just kind of comes down with experience. But if I recognize that there's a place that there's going to be massive resistance, like say up here, because of the gap and the spike high, and we're here, then yeah, I'm okay with taking profits there, especially if I got in way down here. There's no point in really risking at that point. But it's more or less a comfort thing. There are two major things that you need to know about trading: psychology and support and resistance. And support and resistance I include as part of the trend. So definitely what's comfortable with you, follow what the larger time frames are doing. That's the biggest thing I can pound into your head into this course.